Hello traders, and welcome to the moving averages section of this course. So just to explain what moving averages are, also this is accompanied by some text. So moving averages, they use a mathematical calculation to draw on this sort of line, which uses some candles, sort of the close level of the candles to work out, okay, well, what's the average sort of price in that over that period of time. So for example, this is the 50 exponential moving average, so it uses the last 50 candles, it works out a mathematical calculation and plots on this line here. So with that, it's basically saying this is like the average price sort of currently over the last this is the 50 candles, so last 50 candles, this is the average price, and you use that to sort of say, okay, well, if price is above or below, we know that we can take a trade accordingly. So when price is above, you generally take long trades, and when price is below, you generally take short trades. Okay, so the text will explain the difference between a weighted mean average, exponential average, and a simple moving average. Okay, so there's three types of moving averages there. We generally use the exponential moving averages just because it's smoother. It sort of filters out any erratic moves in the market, any unusual moves. With the 50 EMA, this is a quite key one because it acts as sort of a dynamic support or resistance level. So you see when price generally comes towards it, it has a nice little reaction, a sort of a bounce. So price broke below it here, came back to it, and then bounced down quite nicely. As you can see, more recently, price has come to the moving average and then sort of a nice fake out, bounce above it. Here you can see price wicked off of the moving average. Again, going back to around here, bit of a bounce here after a nice sort of fake below. If we go to a different chart, we might see the same. Okay, so on this chart here, what we can see, nice bounce here, bounce here. So this one looks a bit cleaner than the first chart. Okay, so generally some bounces, bounce here, bounce all the way along here. Basically, you can see this is a really good example of when price is acting as a level of resistance. Sorry, the moving average is acting as a nice level of dynamic resistance. And then we'll look at sterling Aussie to see if we can spot the same on this chart. So here, fake out, nice bounce up. Same again here, nice bounce up, nice bounce down just here. A nice bounce around here and around here. So you can see it does occur quite often where price does sort of bounce around the moving average. So these just have a read of the text, familiarize yourself with the moving averages. The ones we use are the 50, the 21, and the 9. So as you can see, the 9 is the blue EMA, and that's just the shorter time frame, so they're more faster reacting. The yellow is the 21 EMA, and the 50 is the red EMA. Okay, so how I like to sort of label them is the blue is the 9, the yellow is 21, and the red is the 50. With that, when you see the blue EMA, if it's above the yellow or below the, so if it's above the yellow, we take long trades. If it's below the yellow, we take short trades. We'll explain why. When price is above the when price is above the 50 EMA, we'll generally take just long trades. If price is below the 50 EMA, we'll generally take short trades. It's better when price sort of pulls back. That's when you take, so let's say, for example, just here, price breaks below, you can take shorts, but we like to wait for the price to pull back to then take shorts. Okay, but we'll explain all of everything that's going on in the next section, in the next video. So thanks for watching. You can now move on to that next video.